Hey guys, welcome back to the channel. I'm here in mission to make every one of you to become rich and richer. Today, I want to talk to you about different types of investments that you can make. Now, before we get started, please like this video, comments, and subscribe for future updates. Also, this video is not intended to be financial advice, but it is intended to educate you on certain types of investments out there so that you can do your own research. Generally speaking, there's a direct relationship between risk and potential return. That is, low risk typically means low potential returns, whereas higher potential returns usually come with higher risk. So, when you're thinking about what investments to make, you need to consider where you are in life, your age, your income, your family obligations, whether you have any debts, and most importantly, your risk tolerance. There is no perfect investment, but there are investments that will suit your needs better than others. We'll start with low-risk investments, move to medium-risk investments, and then finally, high-risk investments. Number 1. Low-risk investments. So these investments prioritize capital preservation and offer stable, albeit typically lower returns. They are suitable for short-term goals or for those with a low risk tolerance. So here are some examples of low-risk investments. Savings accounts and money market accounts. These are basic bank accounts that offer interest on your deposits. Money market accounts typically offer slightly higher interest rates than traditional savings accounts and may come with limited check writing privileges. CDs or certificates of deposit. With this, you deposit a fixed amount of money for a specific period, such as 6 months, 1 year, 5 years, etc., and you earn a fixed interest rate. Early withdrawals usually incur penalties. U.S. Treasury securities, which include Treasury bills, notes, and bonds. These are debt instruments issued by the U.S. government, considered among the safest investments because they're backed by the full faith and credit of the U.S. government. And lastly, investment-grade corporate bonds. So these are bonds issued by financially stable companies with high credit ratings. While slightly riskier than U.S. Treasuries, they still offer relatively low risk and usually offer higher yields. Now, let's talk about the pros of low-risk investments. Number 1. High capital preservation. There's a very low chance that you will lose your principal investment. So that is great for people who have a low tolerance for risk or who have short-term goals. Number 2. Predictable returns. Interest rates are often fixed, making it easy to project your earnings. And number 3. Liquidity for some. Savings and money market accounts offer easy access to your funds. Additionally, low-risk investments can provide peace of mind since you don't have to worry about major market fluctuations affecting your portfolio. Here I will give you an example. Your emergency of 1 to 3 months should be in high-yield saving account that you can withdraw without losing much of principal values. In contrast of putting in stock market, which can be fluctuated, and you don't want to withdraw while your stock tank unless you can embrace the losses. And now let's discuss the cons of low-risk investments. Number 1. Low returns. Typically, the returns on low-risk investments barely keep pace with inflation, sometimes even falling below it. This means that your purchasing power could actually erode over time through inflation. Number 2. Limited growth potential. They're not designed for significant wealth accumulation. And number 3. Penalties for CDs. If you have your money locked up in a certificate of deposit, early withdrawal can result in a penalty, tying up your money. Number 2. Medium-risk investments. Medium-risk investments are those that offer a balance between growth potential and risk. They're suitable for investors looking for moderate returns without taking on excessive risk, often used for medium-term financial goals. Some examples of medium-risk investments include balanced mutual funds, or ETFs. These funds invest in a mix of stocks and bonds, aiming to provide both growth and income while diversifying risk. A common allocation might be 60% stocks and 40% bonds. Another example is dividend-paying stocks. These are shares in established companies that regularly distribute a portion of their profits to shareholders as dividends. While stock prices can fluctuate, these companies often provide a steady income stream. Real estate investment trusts, or REITs, which are companies that own, operate, or finance income-producing real estate. They allow investors to gain exposure to real estate without directly owning property and typically provide regular income through dividends. Preferred stocks, which are a type of stock that pays fixed dividends and has priority over common stock in receiving dividends and assets in the event of liquidation. Their market value tends to appreciate more slowly than common stocks. A real estate also is a good example of medium risk investment. The price of real estate always go up year over year, with some exception during recession, the real estate may goes down. What makes real estate a good investment is you can borrow a large amount of money to buy real estate with low interest rate for long time, 15 to 30 years. This is what we call it a leverage. It means to use someone else's money to make profit on your purchase or investment. The pros of medium risk investments include moderate growth potential, diversification, income generation, and less volatility compared to high-risk investments. However, the cons are that they're subject to some volatility, lower returns compared to high-risk options, and management fees for funds. Number 3. High-risk investments. So these investments offer the potential for significant returns, but also carry a greater probability of losses, including the potential to lose your entire investment. They are typically suitable for long-term investors with a high risk tolerance and who can afford to lose the invested capital. Some examples of high-risk investments include individual stocks, especially small-cap, growth, or speculative stocks. Options and derivatives, which are complex financial instruments whose value is derived from an underlying asset. Commodities, which are raw materials like gold, oil, agricultural products, etc. Cryptocurrencies, which are digital or virtual currencies that use cryptography for security. Hedge funds and private equity, which are often limited to accredited investors and employ complex strategies, often involving leverage and illiquid assets with the goal of generating high returns. And lastly, venture capital or angel investing, which involves investing in very early-stage companies. While high-risk investments can be very lucrative, they're not for everyone. If you are considering investing in high-risk assets, remember that it's essential to do your research, understand the risks involved, and invest responsibly. Let's look at the pros of high-risk investments. So the first pro is high growth potential. The possibility of significantly increasing your wealth is what attracts many investors to these assets. High-risk investments often have the potential to generate returns that far exceed those of more conservative investments. Number 2. Outpace inflation. High-risk investments can help you earn returns that comfortably beat inflation, which is crucial for long-term wealth preservation. When your investment returns keep pace with inflation or outstrip it, your purchasing power grows over time. The cons of high-risk investments include high probability of loss. It is important to acknowledge that a significant portion or even all of your invested capital could be lost. High volatility. Prices can fluctuate wildly in short periods, leading to stress and potentially forced selling at a loss. Lack of liquidity for some investments. Certain high-risk assets like private equity or some collectibles can be challenging to sell quickly if you need to access your money. Complexity. Many high-risk investments are intricate and may require in-depth knowledge and experience to navigate successfully. And finally, not suitable for all. These investments are generally not suitable for those with a low risk tolerance or who need their capital in the short term. There are some other things to consider before you invest. So I want to share with you 3 important things. First is diversification. So spreading your investments across different asset classes, industries, and geographies is vital. This helps you manage risk because if one investment underperforms or faces losses, it shouldn't severely impact your entire portfolio. For example, if you're considering investing in individual stocks, diversify by investing in stocks from various sectors. If you invest in technology stocks and those stocks decline in value, your other investments in different sectors could cushion the blow. The second important thing to consider is your time horizon. Time horizon refers to the length of time you plan to invest your money. Your investment choices should align with your time horizon. If you have a long time horizon, typically 5 years or more, you can usually take on more risk. For instance, if you're investing for retirement, which is likely more than 5 years away, you might consider a more aggressive investment portfolio with a higher allocation to stocks. But if you have a short-term goal, like buying a house in the next 2 years, you'd want a more conservative approach to protect your capital. And the third thing to consider is your risk tolerance. Risk tolerance is your ability and willingness to handle the ups and downs of the market. How much volatility can you stomach? Are you comfortable with the possibility of losing some of your investment in pursuit of higher returns? Or do you prefer to play it safe, even if it means lower potential returns? To determine your risk tolerance, think about your personal circumstances, financial situation, and emotional response to market fluctuations. Consider investing in high-risk investment with your disposable income. It means after your living cost, expense, and other investment, you still some leftover money that you won't be too stressful to lose it. Investing is a powerful tool for building wealth, but choosing the right investment is crucial. Whether you're looking for stability, growth, or a balance of both, there are numerous options available. Remember, the best investment is the one that aligns with your financial goals, risk tolerance, and time horizon. Last thing, where does gold and silver fit in? These two precious metals are known as safe haven to store your wealth. It's very liquid when you need to cash it. I always recommend for you to hold some gold and silver as part of your diversification. I will talk more about gold on next video. Thank you for watching this video. Please like and subscribe, that will support this channel a lot. If you have any questions, comment below. I will try to respond to your questions as soon as possible. Also, if you have any suggestions for future videos, leave them in the comments section. Hope you have a profitable day.